Taking a look at the major averages, stocks are higher today on news that top U.S. and China officials will finally meet for trade talks coming this weekend. But could a hawkish tone from Fed Chair Jay Powell at this afternoon's presser derail some of the market momentum to the upside? Joining us now on that, Tim Murray, a strategist at Rowe Price Capital Markets. Tim, great to have you on this morning. Talk to me about the price action that we're seeing off the back of news of these trade talks, seeing a bit of a lift in stocks here. To what extent do you think that rally can continue based off of headlines about talks versus actual news of trade deals?
Yeah, I mean, obviously, any news of progress from China, any news of de-escalation is going to be good for the market. For the time being, I think that's the key here is for the time being, we aren't going to have a whole lot of economic data. All of the earnings data that we're going to get is going to be from first quarter. And, Liberation Day was April 2nd. First quarter ended March 31st. So I would say right now, that's kind of all we have to go on is what's coming with these trade talks. So I think as long as you get some positive momentum there, it's not going to be derailed by something else as far as the data is concerned. Now, once we get to July, August, I would be much more concerned about the data starting to derail any kind of good vibes on trade.
Right. So super short term in the next couple of weeks here, when it comes to headlines coming out of these trade talks, what would make you more bullish?
So I would say one of the most important things to watch is the 10%. So we came into this year with the aggregate tariff rate on a weighted average basis that we were charging the rest of the world. It was 2.5%, something in that neighborhood. And then we got the tariffs put on, the reciprocal tariffs, and a 10% blanket tariff, right? So even if we get rid of all of the reciprocal tariffs, you still got 10% left. That's a 400% increase in tariffs. So what I would be watching is that 10% a floor or not, right? So if we start to see deals where we actually get that 10% would get down from that 10%, that would be a really good sign. But if the 10% kind of looks like a floor, that's going to be tough unless you get really big exemptions.
Yeah, and to that exact point, how do you trade in this environment, Tim? I noticed in your notes that you sent over, you talked about the 6 to 18-month outlook being extremely opaque. How do you allocate capital when you can't see a year and a half from now?
Yeah, so what I would say is you need to make sure you have a plan. One, what we do know is there's going to be a lot of uncertainty and a lot of volatility going forward. So I would say, one, you want to have cash. You want to probably dial down how much risk you have. And if you're in a situation where you can't stand a lot of volatility, I would look to de-risk your portfolio.
And
fairly significant. But if you're in a situation where you think, hey, I want to take advantage of any weakness, just be prepared for all that volatility. Have a plan going in. You have to look at it and say, hey, this is the point where I think the bad news is priced in, and this is where I would start buying. Yeah. Because the day that the prices look the best is going to be the day when the news is the worst. Just keep that in mind.
Tim, what is the best move when it comes to that de-risking? We've seen the flight to international, the flight to gold. Yeah. What move is the best one in your view?
So I think it's still cash. I do think international bonds is a good alternative to U.S. Treasuries, but just given where the Fed is with, they have dueling mandates right now, not just dual mandates. Yeah. That's going to make them conflicted about, so any economic weakness is not necessarily going to be met with Fed cuts. So I would say cash is probably your best place to be at this point.
All right, Tim Murray, thank you so much for joining us this morning. Appreciate it.
Thanks, Madison.